Now, everyone is looking to cryptocurrency as we see huge run-ups in Dogecoin, and Bitcoin was hitting some record highs just recently. But you want to make sure that you are protected when Uncle Sam wants to collect. So let's talk taxes and cryptocurrency now. We're joined by Pierre, CEO of Pierre Accounting. Eric, so what is the guidance that we have from the IRS and how we should handle cryptocurrency around tax time?
That's a great question, and thank you for having me. Now, it's going to depend on how you acquire the cryptocurrency. So these days now, we have people that are paid in cryptocurrency for their services. If you're paid for your services, so let's say I'm paid 100 coins Ethereum at 2,500, I would record that as 250,000 of income because that's what Ethereum is worth of that day. And then if you're doing the buy and hold strategy, when you buy it, you're taxed depending when you sell it. So if I buy some Dogecoin today, say $1,000 worth, and I sell 3 months later for 10,000, I'm taxed at ordinary income at the 9,000 gain because it's less than a year versus the same coin. Now, if I sell it a year and 5 days later for say 100,000, that $99,000 gain is taxed at capital gains rate, which the cap currently is 20%.
So what if you have a business such as selling NFTs, right, or data mining? What should you know come tax time? What is allowable?
Okay, so selling NFT, you can create an entity and treat it like a business. So if I were to sell, let's say, a digital art of LeBron James dunking a basketball, like recently for 200,000, I would record that as my gross receipt. But if I incurred expenses creating it, such as buying the computer and the digital art, I can deduct it as long as it's considered ordinary expenses to create the digital art. Then I can deduct it against that income. One thing to keep in mind is that if you're into NFT, you're not doing a trade of business, the IRS is looking to potentially treat that activity as a collectible, and the collectible tax is up to 20% for the high earners, and that's for single people at 441 and higher, and married 496. So that's a little different from how they're treating the rest of the coins.
Now, Eric, when it comes to taxes, I think everyone is always looking out for loopholes. What you're saying seems to be fairly straightforward. Are there any loopholes or specific tax laws that perhaps folks that are dealing with cryptocurrency should be aware of or could potentially use?
Yes, that's a great question. Now, you can also create Roth IRAs and traditional IRAs with cryptocurrency that allows you to defer tax or not pay tax, depending on how it's set up. It's a little trickier, but with the right brokerage and the right strategy, you could have a Roth IRA with cryptocurrency, or you can put all of it in a traditional IRA, grow it tax-free, and then pay the tax in retirement with the RMDs, et cetera, et cetera.
Before we let you go, I'm just curious about what counts as a deduction when you're dealing with cryptocurrencies or NFTs.
Can you repeat that? My signal was compromised for a second. I apologize.
Oh, sure. No worries. What would count as a deduction if you are dealing with cryptocurrencies or NFTs at tax time?
Okay, that's a great question. Now, I know that if you're data mining, you can deduct your electricity cost. You can capitalize your server if you were to start data mining today. I actually was looking into mining, but I got out of it because I was concerned about the electricity cost. But I could have capitalized, a $10,000 server. And for NFTs, if you're buying a computer, and of course, if you're listed on sites for marketing, you can deduct those costs as long as you treat it as a regular business.
All right. Definitely some tips that everyone is going to want to take advantage of. Pierre, CPA, CEO of Pierre Accounting, thanks so much for joining us.